Hi guys, today we're going to do a video on traditional IRAs, and that stands for Individual Retirement Account. We're going to go over some of the benefits of having one of these accounts. Let's start with some tax benefits you have. You're going to get some tax deferred growth. So what that means is the investments inside of it, you can move them around, buy stock, sell different investments and buy them inside, and there's no taxes that's going to happen. You don't have to pay any taxes until you start taking money out, which is very, very good. It's one of the best ways you can actually grow your money. And you can grow your money pre-tax, meaning let's say you make, 50 grand a year and you put $5 grand a year into this, you're actually going to be only claiming around $45,000 in taxable income for federal and state income tax, which is a great benefit. So you're paying less in taxes and your money's growing free from taxes while it's inside the account. Now this is a personal account, which means individual. So that's why it's called an individual retirement account. So you can't have multiple owners, it's just the actual account owner themselves. You have to have earned income to contribute to these types of accounts. So you can't have money from royalties, or you can't have money from any kind of passive income, which would be like rental income. It's got to be from a business that you're actually getting like a W-2 from, or a business owner yourself. So you have to have earned income to contribute. The investor is in complete control, which means you can buy literally any stock, bond, mutual fund inside this. You are in complete control. So like, for example, like a 401k or something you have at work, you're gonna have maybe like a list of different investments you can choose from. You can buy anything out there inside this IRA. Some of the different investments that you can have: stocks, bonds, mutual funds, exchange traded funds, which are ETFs. Some of these things we went over in our previous videos. Real estate, as in real estate investment trusts, CDs, money markets, stock options, and structured products. Those things we'll go over a little bit later on in some other videos, but basically, if you can buy it on the open stock market, you can buy it. Here's some of the key factors for tax year 2024. If you're under the age of 50, you can add $7,000 a year to this. If you're over the age of 50, you can have a catch-up contribution of another $1,000, which is $8,000. Now there's some rules here that can get a little sticky about how you can deduct from your taxes. If you're married and both of you have a retirement account at work, which is like a 401k, 403b, and both of you have them and both of you are contributing, the most you can actually make is between $123 and $143. The difference is basically if you're in the middle there, you have to do some math on how much of your contribution you can actually deduct. So if you're over these limits, you can put money in, but you can't deduct it. It will grow free from taxes, but you can't deduct the contribution. If you're under this and you both have plans, you can. If you're married and single, you can only make $10,000. So pretty much if you're married and you're doing single filing, that can be a big factor for you, whether you're, depending on what you guys make, if you guys are going to file married or single. When it comes to doing IRAs, you pretty much can't add and get a deduction if you're going to do married filing single. If you're married and only one of you have a plan at work, it jumps all the way up to $230,000 to $240,000. So basically, if you're under $230,000 and only one of you have a plan at work, you can still get a deduction from your contributions. Okay. If you're married or single and you have no company plans, so let's say you work at your place and there's no 401k, nothing at work, you can make $10 million a year and still add money to this thing and have a deduction. So if there's no plan at work, you can add and get a deduction. Depending on your income limits, that's going to depend on, in your situation, it's going to depend if you can get a deduction. Okay. When you go to withdraw money from this, okay, so if you are younger and you want to take money out of this thing, if you're under the age of 59 and a half, you're going to have a penalty of 10% on any withdrawals you take. Okay? There are certain rules, we'll get into that in a later video, that you can get away from that, but just know, majority-wise, if you're under the age of 59 and a half and you take money out of this account, you're going to pay 10% penalty on top of your taxes. If you wait after 59 and a half, then there's no 10% penalty. But again, you're still going to pay some taxes. Every dollar you take out of this thing when you go to retire is going to be taxable to you, unless you have some of those non-deductible contributions, meaning back to where we talked about before, if you make too much and you have a company plan, you can have non-deductible contributions. That money will come out tax-free, but it'll be a mixture. Also, RMDs. So let's say you've done well in life, you've added money to a retirement account, it's now an IRA, and let's say you don't need the money. That happens sometimes. The government does not care. They want their tax money. Once you hit 73, they're going to make you take out a certain percentage every single year. So there are some limitations on this, on when you can keep it in there. But even if you're taking RMDs, this money should still grow for you long term. But yes, so if you want to, this is for retirement. You want to wait until you're older, till 59 and a half, before you start taking some withdrawals from this and retired. If you haven't taken any money, the government's going to make you take it out at around 73. Start taking it out slowly. And anything you take out of this is going to be basically taxable income to you, unless you got some non-deductible contributions. This is one of the best ways to grow your money long term, because you're going to be growing free from taxes and you get a little bit of a tax benefit for it.